Welcome to Finance, Accounting and Banking, specifically bank reconciliation. Businesses do keep their money in the bank. And when they keep money in the bank, they record those transactions. Either money is flowing in and out of the business through the bank account. And the business keeps an account known as the bank account under the two-column cash book. Whereas the bank keeps an account registered or opened in the name of the business. These two accounts may have differences in terms of the amounts held in them. Because there are some transactions that may be late to be recorded in the cash book, but recorded in the bank. And there are some transactions that may be recorded in the cash book and not recorded in the bank account in time. So that necessitates that we open a bank reconciliation statement. And this is a statement that is prepared to reconcile the causes of differences between the bank balance as per the cash book, this bank column, the balance that you obtain here, and the bank records as per the passbook. That is, according to the bank, the money that is in our account. So, let's say on 30th June 2018, our cash book bank column may read a balance of 80,000 at the end of June. But when we receive a statement from the bank or our passbook, we may find that the balance is 90,000 shillings. So there is a difference. And that difference, for example, in our case, 10,000, must be reconciled because we should not have less money than we have in the bank, or the bank should not report a figure that we cannot account for. So, we know that in modern accounting, there are some rules followed for recording transactions. When assets increase, we debit that asset account, and when they decrease, we credit that account. The same with the expenses. When an expense account increases, we debit that account, and we credit that account when an expense reduces or decreases. The opposite is true for liabilities, capital, and revenues. If a liability account increases, we credit that account, and when it reduces, we debit that account. We credit a capital account or the capital account when it increases, and debit the capital account when it decreases or reduces. Likewise, for revenue accounts, we credit a revenue account when it increases and reduce or record on the DR side of that account when the account reduces. So, we take an example. In the bank, we have 100,000 shillings, and we look at the connection between the bank and the customer or the business, how they look at this money. So the point of view of the business is that it is an asset. Bank is an asset like cash, motor vehicles, etc. So this bank column represents the money that is in the bank belonging to the business. So, we look at that as an asset. And that asset increases or decreases according to the transactions that pass through the bank or the business. So, that asset may increase and we debit that transaction or that account with that transaction. And if the amount decreases, we record the bank account on the credit side to reduce the value of that asset. The point of view of the bank. We are the customer, or we are the bank's customer. So the bank is just holding our money. We are a creditor to the bank. We are owed money by the bank. It is just holding our money. We can ask for that money anytime. So it is a debt or a liability to the bank in our name, in our business name. And if we deposit or others deposit money into our bank account, they are increasing the amount of money the bank owes us. So they are increasing their liability to us, and that is recorded on the CR side. And if the bank releases money on our behalf, the money in our account reduces and they debit our account with that amount that has moved out. That's why you will receive information, either SMS or a call or a statement by the bank telling you that we have credited your account with, let's say, 10,000 if a deposit is made, or we have debited your account with 5,000 if money is moving out of the account of that business in that bank. So, point of view of either the business or the bank. On the debit side, we record an increase in the bank account of the business. But we record a decrease of money from the bank point of view of our passbook. And when money flows out of the business, we record that decrease on the credit side of the bank account in the cash book, this side. But the bank will record on the credit side an increase in money because we are increasing the liability. So, we take an example of the two accounts kept by the business and by the bank regarding the same amount of money. So, when the money flows into the business, the cash book bank column is debited with that amount. And if the money flows out of the business, that transaction and the amount of money is recorded on the credit side of the cash book bank column. In the passbook, according to the bank, if a decrease of the money is observed, or a transaction involving a decrease of the amount of money we have in our account in the bank, it is recorded on the DR side of the passbook account. And an increase in the amount of money that we have in the bank, it is recorded on the CR side by the bank, the books that they keep. And as we have seen, there may be discrepancies or differences. So the bank balance according to the cash book may be different from the bank balance according to the passbook. And we have reasons for these differences between the cash book and the passbook. So, number A some of the items that appear in the cash book and not in the pass book that may bring about this difference. Checks issued by the business and not debited by the bank. If a business issues checks, it will be recorded on the CR side of the cash book. The business has issued or given out money, and it is recorded on the CR side. But the check may delay to reach the bank. But if it reaches the bank, it should be debited because we are issuing a check so that we can pay some money to some people, reducing the amount of money in the account in the bank. So the bank, when it receives that, it should debit that passbook account. But if it has not reached the bank will not reflect that. Checks deposited but not credited by the bank. When the business receives a check from debtors, it will deposit that check to the bank so that it is cleared and our account reflects an additional amount of money in line with the face value of that check. Because if the bank receives that money, it will credit our account. So, if we deposit a check, but it has not been credited by the bank in time, the passbook balance or the bank balance according to the bank will be different from the cash book. Remember, we'll have debited that money in our bank or in our account bank column so that we reflect as an additional money we have received. But the bank may delay and there may be a discrepancy. Then you have errors. If you write 1,000 instead of 10,000 or any other error when recording, it will affect the two account balances. You also have standing orders or instructions or subscriptions. The bank may follow some instructions, for example, pay this amount of money every end month, like salaries, subscriptions, rent, electricity, water, etc. So these will be reflected at the end of the month, but will not have been posted in the cash book in time because the bank statement is received after a month ends and we'll have done our cash book. So when we receive the statement, we'll then adjust later. But the standing orders will have necessitated a reduction of money from the account or passbook. Then you have some items that appear in the passbook and not in the cash book, like bank interest. And we don't know the amount that may be charged for whatever transactions or bank charges. You also have direct deposits into the bank account by suppliers or debtors. You also have bills for collection, interest and dividends collected by the bank from our investments. So when we are receiving money, it means that the money has been deposited by debtors or our customers. We receive a check to the business and then we deposit that money into the bank. It is cleared and our bank balance increases after the bank clears the check and credits our account. and credits our account, credit side. If we are making a payment, we are issuing out or giving out money, or we are drawing a check as the business to suppliers to pay them. And they will present that check to the bank to be cleared. So, when it is cleared, the bank balance in our passbook or account will reduce. So, our bank balance reduces after the bank debits it or the check. So, bank reconciliation statement. Example, the following is an extract from the bank and cash books column of John Johannes on 30th June 2018. So you are required to write the updated cash book and write the new balances as at 30th June 2018. And then you draw up a bank reconciliation statement as at 30th June 2018. So the cash book looks like this. The starting balance 495,000. Daniel Adeta pays us 76,000. Joseph Adeta pays us 54,000 on 15th, 18th, and 1st, respectively. On 26th, we receive cash equivalent to 88,000. And we also receive money from Ronald Adeta, equivalent to 116,000. And we will have paid out money in form of a check to Henry, 47,000 on 5th. On 26th, we pay Paris, 106,000. On 28th, we pay Dennis, 42,000. The debit side is larger than the credit side, with a difference of 534,000. And then we will receive a bank statement from our bank with the following details. On the 1st, we have balance brought forward 495,000. This amount is reflected in the bank. On 8th, a check of 76,000 is received in the bank. It is credited. Remember, when money increases in the bank, the passbook is credited and it is received from Daniel. On 9th, some money is debited because we have paid Henry. The check delayed to be cleared. It was issued to Henry on 5th, but it was cleared by the bank on 9th, 47,000. On 15th, the bank received a check of 54,000 from us because we had been paid by Joseph Adeta, 54,000. On 26th, we received cash through the bank equivalent to 88,000. And on 29th, there was credit transfer to Doris equivalent to 52,000. This has not been reflected in the cash book, bank column, or bank account, together with the bank charges, 40,000. We have the balances fluctuating, and the final balance here is 678,000. So, those items on the credit column represent an increase in money in our bank account according to the bank, and the amounts in the debit column of the statement represents monies paid out by the bank on our behalf. This side, DR side, represents receipts that we receive at the business or in the business and the business account. And these monies on the credit side represent monies paid out through the bank. So, the DR side of the bank account cash book should be or reflect the same amounts on the credit column of the bank statement. And the monies or transactions recorded on the CR side of the bank account of the cash book should be the same with those monies recorded on the DR side. We further look at the problem. So the workings. So here we assign DR side, left hand side, CR side. And we record all the transactions that are in the cash book here and those that are in the bank here or passbook. On the credit side, those transactions in the cash book and those transactions of the passbook are according to the bank, we record them down here. So 495 DR side, 495, 76, 54, 88, and then 116. 116 is in the cash book, but it is not reflected here. This is represented here, but this 116 is not represented here. We said that DR side is reflected on the CR side of the bank statement. So we have 76, 54, 88. 116 is not reflected here. We write it here. Then we look at the credit side of the cash book. We have 47,106 and 42. 47 is reflected again here. But 40, 106 and 42 are not reflected. So 106 and 42 are recorded at the top here because they belong to the cash book. This will be recorded under the bank. So, on the debit side of the bank account, passbook, according to the bank, we have 47,000. You don't write them twice, you write them once. Then we have 40,000. 47,000, 40,000. Then, on the credit side, we record those transactions that have not been reflected or that should be there. So we have 76,000 in the bank. 54, 88, and 52. 76, 54, 88, and 52. 52 is not reflected anywhere, and we have to reflect it now. So after this, we update the cash book. We have the DR side and the CR side. The DR side to take 495,000, then 76,000, 54,000, 88,000, 116,000, and 52,000. that has or had not been reflected. You have 76, 54, 88. This had not been reflected, this had not been reflected. We recorded that here. Then, on the credit side, we record the 47,000, 106,000, 42,000, and 40,000. We don't repeat the 47,000. And then we look at the differences. So the debit side has a higher amount than the credit side. The total is 881,000, and the difference is 646,000, balance carried down. So this is the amount of money that we should be having in the bank. Then we adjust the bank reconciliation statement. So balance as per cash book. Then we add unpresented checks, the checks that have not been presented to the bank for clearing. Unpresented checks have not been credited by the bank, this and this, that were not appearing in the bank but were appearing in the cash book. We add them, and then we subtract uncredited checks. This side is for uncredited checks, this is for unpresented checks. So uncredited checks, these had not been credited by the bank. We deduct that and we get the balance as per the bank statement. Look at this. This is the balance of the bank statement. The bank statement that was sent to us had this balance. It is saying that we have this amount of money in the bank. According to the passbook, it is the same amount that is reflected here after we adjust what had not been entered in the cash book and the bank statement. Thank you for watching. Remember to subscribe and like my videos. I'm Edward Kariuki Mathenge, KariukiEddie2010 @gmail.com.